Section 2:2 Introduction to Modern Portfolio Theory. 2.2 The Efficient Frontier. The efficient frontier is a key concept in modern portfolio theory, MPT, that helps investors identify optimal portfolios that offer the highest expected return for a given level of risk or the lowest level of risk for a desired expected return. The efficient frontier is a graphical representation of all possible portfolios that can be constructed using different combinations of risky assets. The efficient frontier is derived from the principles of diversification and the risk-return trade-off. It shows the range of portfolios that provide the best risk-return trade-offs, considering the available set of risky assets. Portfolios that lie on the efficient frontier are considered efficient because they offer the highest expected return for a given level of risk or the lowest level of risk for a desired expected return, making them preferable to portfolios that lie below or to the right of the frontier. To construct the efficient frontier, MPT considers the expected returns and standard deviations, or risks, of the individual assets in the portfolio, as well as the correlations between them. By combining assets with different risk and return characteristics, MPT aims to find the optimal asset allocation that maximizes the expected return or minimizes the risk for a given level of return. The efficient frontier is typically represented as a curve on a graph, with the x-axis representing the portfolio's standard deviation, risk, and the y-axis representing the portfolio's expected return. Each point on the efficient frontier represents a specific portfolio allocation, indicating the risk and return characteristics associated with that allocation. Investors can choose their preferred portfolio from the efficient frontier based on their risk tolerance and return objectives. For example, an investor seeking a higher return may choose a portfolio with a higher expected return but with a corresponding higher level of risk. Conversely, an investor with a lower risk tolerance may select a portfolio with a lower expected return and lower risk. It's important to note that the shape and position of the efficient frontier can vary based on the available set of assets and their risk-return characteristics. Factors such as the expected returns, volatilities, and correlations of the assets will influence the shape and slope of the efficient frontier. The efficient frontier provides investors with a systematic approach to portfolio construction and helps them make informed decisions about asset allocation. By selecting portfolios on the efficient frontier, investors can optimize their risk-return trade-offs and construct portfolios that align with their investment goals. The trade-off between risk and return is a fundamental concept in portfolio construction. It refers to the relationship between the potential rewards, return, an investor can expect from an investment and the level of uncertainty or potential loss, risk, associated with that investment. Here's a closer look at the trade-off between risk and return in portfolio construction. Return represents the gain or profit an investor receives from an investment. It can come in the form of dividends, interest payments, capital appreciation, or other income generated by the investment. Investors seek higher returns as they aim to grow their wealth or meet specific financial goals. Risk refers to the potential for loss or variability in investment returns. It encompasses various factors such as market fluctuations, economic conditions, interest rate changes, and company-specific risks. Investors generally prefer lower risk as it provides a sense of stability and reduces the potential for significant losses. The trade-off between risk and return can be summarized as follows: higher returns equals higher risk. Generally, investments that offer the potential for higher returns tend to come with higher levels of risk. This relationship exists because higher returns often involve greater uncertainty or exposure to market fluctuations. Investments such as stocks, emerging market securities, or high-yield bonds typically have higher potential returns but also carry higher risks. Lower returns equals lower risk. Investments with lower risk tend to offer lower potential returns. Investments that are perceived as safer, such as government bonds or highly rated corporate bonds, generally provide lower returns because they have lower levels of risk. These investments offer more stable income and preservation of capital but with limited growth potential. Risk tolerance. The optimal trade-off between risk and return depends on an investor's risk tolerance. Risk tolerance reflects an investor's willingness and ability to take on risk. It varies from individual to individual and is influenced by factors such as investment goals, time horizon, financial situation, and personal preferences. Some investors are more risk-averse and prioritize capital preservation, while others are more risk-tolerant and pursue higher potential returns. In portfolio construction, the goal is to find the balance between risk and return that aligns with an investor's risk tolerance and investment objectives. Modern portfolio theory, MPT, provides tools and techniques to construct portfolios that optimize this trade-off. MPT emphasizes diversification as a means to reduce portfolio risk by combining assets with different risk-return profiles. By constructing diversified portfolios along the efficient frontier, as discussed earlier, investors can seek an optimal balance between risk and return. It's important to note that while the risk-return trade-off generally holds, it is not a guarantee or a direct relationship in every individual case. Investments can perform differently, and unexpected events or changes in market conditions can alter the risk-return dynamics. Therefore, it is crucial for investors to conduct thorough analysis, consider their risk tolerance, and regularly review and adjust their portfolios to manage the trade-off effectively.